Welcome to our webinar on the trend is your friend, understanding trends and trend lines. Now, as you saw in the quick video, the introduction video, ETX is a regulated provider, and I'm therefore required to give you a risk warning. So let me read that. I'm going to read the first paragraph, and I would appreciate it very much if you could read the rest of it. Trading the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risk or seek independent advice if necessary. Now, ETX is a regulated provider, and our parent company, Monaco London, is a member firm of the London Stock Exchange. Tonight's class is being recorded, and if you want to see a recorded version of this class, you can use the same link you used to attend this class in about 24 hours. Also, I'm going to be sharing with you a video presentation I prepared for this class. And if you'd like to see that again, you can use the link that I just sent you. That'll take you to the playlist, and then just look under trends and trend lines, and you'll be able to see that short presentation there. So tonight we're going to be talking about the trend and trend lines. So let's get started. Now, as a trader, you have probably heard the old adage that it's best to trade with the trend. The trend, say, all the pundits is your friend. This is sage advice as long as you know and can accept that the trend can end at any time. And then the trend is not your friend any longer. So how can we determine the direction of the trend? I believe in the KISS rule, keep it simple, stupid. So here's a method for determining the trend and a simple method of anticipating the end of the trend. Now, before I get started, I want to mention the importance of time frames in determining the trend. Usually, when we are analyzing long-term investments, the long-term time frame dominates the shorter-term time frame. However, for intraday purposes, since we're all trading with ETX, that means we're trading CFDs and Forex in short-term windows. So the shorter-term time frame has more value to us. Trades can be divided into three classes of trading styles or segments: intraday, swing, and position trade. Now, before we talk about trends or trend lines, we have to understand that there's a big difference between a trend and a trend line. A trend really has no rules to it. So the goal here is to determine the trend direction, not when to enter or exit a trade. Of course, this is not to say that there is no trading opportunity in the shorter term time frames, such as the daily and hourly charts. But for those traders who want to trade with the trend, rather than trading the correction, one could wait for the trend to resume and again trade in the direction of the trend. A trending market is one in which price is generally moving in one direction. Sure, price may go against the trend every now and then, but looking at the longer time frames would show that these are just simple retracements. So a trend is no different in financial markets than it is in women's dress styles or hemlines, or in cars and colors or size of cars. It's an overall market movement. Okay. And we can only have three trends. We can have an uptrend, a downtrend, or sideways trend, which we call sometimes range or congestion. The surprising part is that the market spends most of its time in the sideways trend. Now, if we observe that women's heels are getting higher and their shorts are getting shorter, we can observe and see a trend in this manner. And as we see that happening, we can just say, okay, the overall trend is higher heels and lower skirts. If we've seen lately in the automobile industry, a lot of dealers are doing away with sedans because we're into SUVs now. Smaller SUVs, but SUVs, pickup trucks. Or maybe we've seen people moving away from black cars, and red cars are becoming more popular, or red, blue, and white. Whatever, we'll see a trend in that manner. And most trends are just simply done by observation. Now, in the financial market, a trend is usually noted because you need something, some data to tell you this trend. If you're looking at women's heels, you'd have to measure their heels and you have to measure their skirts. If you're looking at colors of cars, you'd have to look at sales numbers. So in the financial market, we're looking at higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. When trading a trend-based strategy, traders usually pick the major currencies as well as other currencies utilizing the dollar because these pairs tend to trend and are more liquid than other pairs. Now, let's go over to a real chart for a minute, a live chart, and let me pop that up on your screen. And let's observe a trend. So let's go look at the euro US dollar. Now, we can notice that euro US dollar is in a well-defined downtrend. It was in a very well-defined uptrend. Now, what we have to remember is price doesn't move this way. Price moves in zigzags or peaks and valleys. Push and ease, push and ease, push and ease. So in other words, in this uptrend, so price push up, ease back down, push up again, ease back down, push up again, ease back down, push up. And that gives us a well-formed trend. Now, you can have trends that aren't well-formed and well-defined, but the more well-formed and the more defined that a trend is, the better our trading will be in this manner. See, in a downtrend, push, ease, push, ease, push, ease, push, ease, push. Now, we can see, and this is the current euro market in a one-day trend, we can see uptrend, sideways congested or sideways range-bound trend, and a downtrend. Look at that. 3 beautiful trends in one chart. This happens to be a freak of nature because I just teach from this chart all the time. So we see all 3 types of trends. Now, the reason we have this movement up and down in a well-defined trend, because at some point, somebody started buying in the markets, pushing the price up. Now, these people who bought down here at the bottom, or companies, industries, hedge funds, said, okay, I'm glad to take my profit at this level. And because this was a strategic resistance level, a lot of traders had set their take profit level at this point. So what happens is price is moving up, and at a certain level, especially at a resistance level, it triggers a lot of sell orders because people are leaving the market and taking their profit. At the same point, because prices increase significantly, a lot of the buyers who are interested in buying saying, this price is just getting too high for us, and they move to the sidelines. So what happens is price eases up. And those sellers are wiped out and price comes down. Those buyers that move to the sidelines say, now we're getting more interesting. We're going to start buying. And they move in the market to start the buy and push price up again. Now, this is just a regular cyclical thing. It's an easy thing to understand. To trade from that is difficult. But we're not looking at this for trading. Here we're just looking to interpret price action because you always want to trade with the trend. Why? Well, picking an entry point opposite the trend, like saying, here it's hit the peak, so it's going to come down now, and entering a short, well, we have no idea how far it's going to go before it bounces back and retraces. We have no idea where it's hitting its peak to reverse down. And ultimately, you'll make more pips by trading with the trend. You could make a very good trend trading against the trend. I mean, this would have been a nice little profit scenario, but ultimately you would have wanted to get that profit scenario. So trading with the trend generates more possibilities for profit. And we only want to trade at any given time high probability, high success possibility trades using our risk management and risk and reward management to make sure we're getting into the most advantageous trades. So let me get some of these markings off of here. Okay. So a uptrend is marked by higher highs and higher lows. So what happens is you see this price pushed up, forming a higher high. Came down here and formed a low, but it's a higher low than this low. Pushed back up here, came back down, reaching a higher high, and then here it made a higher low. So we have a stepping process here and a stepping process here. Higher high, higher low, higher high. So this is a well-developed trend. The more well-developed that trend is, the more successful you're going to be at trading that trend. Now, the fact is, there are so many assets in the market, and these assets are always trending. So if you're looking at an asset and it's not trending, they walk away from it. Go find one that is, because there's always opportunities. So let's go back to my PowerPoint and let's pick up a little bit from here. Okay. So one of the best ways to look at a tool, to look at a price, is simply by eyeballing it. Okay. You can look at it and see if a currency pair is trending or not. Okay. And then there's other tools to tell whether it's trending, like putting a moving average on and seeing when price is trading above the moving average. That will tell you that price is trending up or down. So remember, there are three types of trends: uptrends, downtrends, and horizontal trends. Along with these three trend directions, there are three trend classifications that have to do with time duration which the trend is taking place. A trend of any direction can be classified either as a long term, an intermediary term, and a short term. Okay. So going back to the chart we have here, the longer term trend is not one that has lasted longer. It's one where you're looking over a longer period of time frame is well formed. Okay. A short-term time frame is a short-term trend is one that occurs in a longer-term time frame. And a medium-term trend also can appear. So you can have ultimately a long-term uptrend with a short-term downtrend with a medium-term uptrend. Okay. Now, which one is more important to you? Well, first of all, to make a lot of people, a lot of traders, or a lot of experienced investors, when you use the adage, always trade with the trend, they're looking at the long-term trend. So if we were looking at this chart and we said, okay, this asset is actually trading in a downtrend and we have a short-term uptrend, would you want to trade against the overall trend? You know, if that overall trend is steadily moving up and up and up, like the euro has been steadily moving up from when it fell down to 105 all the way up to 115, well, do you want to gamble that it's going to fall down? Okay. But we're trading in short-term time frames. So let's go back to that chart I had up here for you. Okay. Now, what we have on here is a current downtrend. Now, this is a one-day chart. If we were to move this chart to a 1-hour chart, we might see something completely different, because what we have is a shorter term or medium term, beautiful uptrend. If we then move it down to our finest trading time, say a 15-minute trading time, well, we still have an uptrend, but we currently have a shorter term downtrend, but we have we can see a uptrend. So that tells us we have a long-term uptrend with a long-term downtrend with a medium-term uptrend with a short-term downtrend. Now we can go back and draw these on the charts. So let's go back to the 1 hour. Well, let's start with the 1 day again. And we're going to actually put the line on the chart. So let's go to draw a trend line. And this is a downtrend. So in a downtrend, now we're not drawing a trend line. We're just drawing a line to denote the overall trend. So let's make these in gold. Let's make them pretty thick. Because we're not, like I said, we're not drawing a trend line at this point. We're just drawing the trend, the overall movement. So now when I drop back down to the 1 hour, that line remains on my chart. So what I see here is this is my long-term downtrend. But I see on my chart a different trend. So I'm going to draw on here and pull my overall trend here, and let's color code that purple. Okay. So now I have a long-term downtrend, a medium-term uptrend, and now I'm going to go back to a 15-minute chart, and my lines still remain on there, and look how well this 1 hour medium-term time frame still fully supports this 15-minute. And this 15 minutes, what we're most likely going to use to enter the market. We go back to a 5-minute. Look how much support we get on that trend line. So what we know is we have a very well-defined market move in an uptrend. So the other way that I mentioned before is by using a moving average. If we were simply to place a 7-period moving average on our chart and combine a 7, a 20, and say a 65 or a 50, okay, and put them on our charts, we could see how the moving averages start to fan out from each other. Okay. When the moving averages, shorter-term moving average fans out from the longer-term moving average, we then would know that we have a trend is up. So if the 7-period moving average fans out on top of the 20-period moving average and on top of the 65, then we have an uptrend. The opposite is true for a downtrend. So we can use moving averages to also help verify the fact that we have a trend. We can also use Bollinger Bands to help. And Bollinger Bands is one of the indicators that works extremely well with trend lines. So one tool that is often used for range-bound strategies can also be helpful in trend discovery. And we're talking about Bollinger Bands or just the bands. One thing you should know about trends is that they are actually quite rare. Contrary to what you might think, prices really range 70 to 80% of the time. In other words, it's a norm for prices to be in congestion and moving kind of sideways. So if price deviates from the norm, then they must be in a trend. What is one of the best technical tools we have mentioned previous that measures standard deviation? Is Bollinger Bands. The Bollinger Bands make it easy to confirm a trend visually. Downtrends can be confirmed when price is in the sell zone, and that is below the moving average and closer to the lower band, and uptrends can be confirmed when the price is in the buy zone or towards the upper bands. Now, we have whole classes on Bollinger Bands, so you can come to us. Now, another part of understanding a trend is like when I built it for you and you saw the push up, the push down, is understanding waves or cycles. So knowing the trend does help in taking a position, but bear in mind that the markets move in waves. These waves are called impulse waves when in the direction of a trend, and corrective waves when contrary to a trend. By counting the waves or pivots in each wave, one can attempt to anticipate whether a trading opportunity will be against the trend or with the trend. Now, there's a whole set of theory on this called the Elliott wave theory. And we have a class on the Elliott wave theory. But according to Elliott wave, an impulse wave usually consists of 5 swings, and a corrective wave usually consists of 3 swings. So push, ease, push, ease, then market reverses and it falls, and eases, push, ease 3 times, and then it'll reverse in the other direction. A full wave move would consist of 5 swings, with 2 of the swings being counter trend. Those are the eases. So the full wave is 5 swings. Push, then the ease is the swing or the counter trend. Push in the direction, counter trend, ease. Push in the direction, counter trend, ease. So the image gives an example of Elliott wave. Because Elliott wave theory can be very subjective, I prefer to use pivot counts to help me determine the wave exhaustion. This usually translates into a minimum of 7 pivots when going with the trend, followed by 5 pivots during the correction. Sometimes the market will not cooperate with technical assumptions, but it can occur often enough to provide some lucrative trading opportunities. So here you can actually see the push, the ease, the push, the ease, the push, the ease, the push, and the ease to give us the 7 pivots. Again, this is a different class, so we have to talk about, and this is on understanding waves and swings. But by combining moving average diagnosis with pivot count, and then fine-tuning the analysis and observation maybe with candlesticks, a trader can stack the odds of making a successful trade in his or her favor. Remember, trading is a craft, which means that it is both art and science and requires practice to develop consistency and profitability. The bottom line is one of the easiest and most reliable ways to make money trading Forex is to follow trends and let winning trades run as long as they will run. When you trade like this, most of your trades are likely to be small losing trades. Remember, always use risk management, profit and loss ratios, but sooner or later, they are more than paid for by the few huge winners. It takes some discipline to trade like this, but it is pretty easy. You don't need to be a genius and even very experienced and knowledgeable to trade probability in this style. What you do need, of course, is at least one trend to exploit. When the Forex market is very flat and trends are completely absent, trend traders can avoid losing money if they want to participate, so identifying trends becomes really vital. Now, the identification of patterns and trends are techniques used by analysts studying supply and demand of an asset traded on the open market. A trend is just a general direction of price over a time period. Analysts use trend lines and channels, which are essentially boundaries for price fluctuation, in an attempt to spot and define trends. Upward trends are characterized by an asset price hitting a series of higher highs and higher lows. But once you've identified the trend, you now have to turn it into something you can use. And this is done by a tool called a trend line. And this is part of technical analysis, and it's one of the few rule-based processes. There are a number of analytic tools businesses use, not just trading Forex and financial markets, but businesses on a whole use trend lines. Okay. When we were looking at cars and talking about sedans and hatchbacks and SUVs and pickup trucks, or we were talking about reds, whites, and blues, you can have a gut feeling that blue is doing better than red and the trend is moving toward blues from reds. But at some point, before you can make a business decision, you have to analyze it. And this analysis can be done by charting the number of sales and then looking for a trend line, because you don't want to just say, okay, we're going to take the last 3 months, and yes, we saw red cars outselling blue cars, and make a whole big corporate decision. No, because maybe that was just for 3 months, and now it's going to switch back to red again. Okay. So trend lines can present a clear picture of a trend in your business by connecting a number of points on a graph. What is revealed is a possible downtrend or uptrend in the direction of the group values identified in the data. Understanding how to use trend lines can help reveal what might happen in the future. Trend lines represent a charting technique, which a line is added to represent the trend in an asset. Drawing trend lines is as simple as drawing a straight line that follow a general trend. Trend lines can be used to identify trend reversals. Trend lines are a useful tool for visually highlighting a trend and potentially being part of a trading strategy. There are a lot of myths and inaccurate information about trend lines, though. Learning how to use a trend line effectively, if you're going to use them, is crucial so you don't fall into many of the common traps. Trend lines are tools. Trend lines have the ability to potentially alert us when a pullback is happening or a trend is over or resuming. So as you can see on the chart, an upward trend is drawn at the low points of an upward trend. Notice how the price is propped up by the level of support. You can now see how this trend line can be used by traders to estimate the point at which a currency pair will begin moving upward. During an uptrend, we see the progress of swing highs and swing lows. Price moving up steadily. We see the trend that's really well developed. Okay. Now, how do we actually turn that into information we can use? Okay. So, a trend line helps us take the noise out of the markets. And because they have rules, now even though you can personalize them somewhat, you still have to have rules. And by having a rule-based trade or rule-based trend line, you're now starting to take that random information you have on your charts and put it to use. So anytime there are two highs or two lows, a trend line can technically be drawn. The trend line is drawn by connecting one high to the next or one low to the next. So in an uptrend, you're connecting the lows and drawing the price point underneath. In a downtrend, you're connecting it above. When starting out, draw as many trend lines as possible in all directions. This helps differentiate pullbacks and short terms. Now, trend lines can be constantly adjusted because price should not break the trend line. So when price breaks the trend line, now it could be, if you're using all lows, it could be the lows. If you're using all closes, it's when the close breaks the trend line. Okay. We just redraw the trend line. We often have bias when we look at price charts, which may not always be correct. By forcing ourselves to draw all relevant trend lines, especially at the far right of the chart, we may realize our initial bias wasn't correct at all. Now remember, we drew those three trends, those three lines on the chart using the 1 day, the 1 hour, and the 30-minute. Now they weren't drawn by rules, but if we take those trends and those trend lines and adjust them by the rules, we're going to have those lines tell us a little bit more information. So trend lines are not only based on price, but also have a time element. This creates a great myth. Traders will often say that because a trend line is broken, the trend is over. This is not true. Trend lines can be redrawn. It doesn't mean the trend is over. If you break it, you just correct the trend line. Maybe the wave shifted. Sometimes the momentum shifts. An asset can be trending very hard up, and at some point, that momentum is going to shift because that asset's getting higher and higher. But it doesn't mean the trend is over. It just means that trend line is over because it's now broken that, but it's still moving up beautifully. You just draw your new trend line. So trend lines are not only based on price, but also have a time element. This creates the myth. Okay, so as you can see, once we get this trend break here, This trend wasn't over. Just this trend line was over. Okay, it had a change in its development. It had a change in the market, but the trend wasn't over. So we would then redraw this trend line using these lows and push it out forward. So for example, if price is making rapid higher highs and higher lows, the trend line will be angled steeply upward. This type of momentum can't last forever, and eventually the trend will just slow down. The price will break the trend line, but it doesn't mean the trend is over, just that it is slowed down. Trend lines will often need to be redrawn. So here we can see in this uptrend, because as time takes the element as price moves forward, we need to have the correct. So you can see in this chart how many times as the asset moved forward did we redraw the trend line. So this trend line that we would be currently relying on up to this point would never have been able to be drawn until this low was created. So we would have never ever been out of it. This trend line could have never been created until that low was created. So we would have had to depend on these lows at this time. The trend still continued to develop. So the very first thing you need to know about drawing trend lines is that you need at least 2 points to connect together. But it's not a valid trend line until it has a third touch. An uptrend is identified by price making higher highs and higher lows. So in other words, what we're looking at on the screen right here is we would have drawn this trend line based on these two lines and projected out to the forward. But until this connect here, this was just a trend line. It wasn't valid. It wasn't something we could use. You need a third touch to validate that trend line. It's also important to adjust trend lines with new swing points and when you often find that you will need to allow for some spikes through the trend line where price tested and failed. So there are 3 very important keys to drawing trend lines effectively. The higher time frames will always produce the most reliable trend lines. So start there and work your way down. Most trend lines you come across will have some overlap from the high to the low candles. And never try to force a trend line. So I've got a little presentation. I'm going to pop it up on your screen and share it with you to show you some essence of, and this is a quite unique presentation because what we're using here is not the swing low. We're using the close as a more important price when drawing the trend line. You might have to turn up your volume to hear this also. So be aware, there is voice, but it sometimes is lower. So as you can see, the goal of every trader is to buy low and sell high within a price trend. The trend lines give us a way to identify the high and low ranges of the trend. As an example, if we are looking to buy based on our fundamental view, and the trend is pulling back up to the uptrend line, this gives us an area to actually enter and buy a currency at a low price in the current trend. The exact same is true in a downtrend. If we're looking to sell a currency based on our fundamental view and is pulling back to a downtrend line, we now have an area to sell the currency at the high price in the current trend. So using trends and trend lines can help give us an edge and help us interpret price action. Now for me, my firm belief is that every trader needs to be able to look at a financial chart, apply a trend line, and apply support and resistance levels, regardless of how they're going to make a trading decision. Okay. This will give you the basics of at least having the knowledge and understanding of how that asset is moving. So reading a chart, understanding how a trend moves, understanding how to put a trend line on a chart, and then adding that with support and resistance and volume can either be a trading system or it can be part of your overall just knowledge of that asset. So thank you very much for joining us. We'll talk to you again real soon. And again, you can see a recorded version of this class by using the link you used to come to tonight's class, or you can see that little presentation we just did by going to the link I just popped up on your screen. Thank you very much. Thank you for being part of ETX, and we'll talk to you again real soon. Good night now.